Recently, I developed part of a financial literacy course for Arizona State University, and I really like the format. So today, I'll use the same structure to talk about asset allocation, which is a critical building block of any comprehensive financial plan. I'll show you how the rich people allocate their assets, and I'll add on my personal experience and lessons learned in the past 9 years in the end. So don't miss it. Hi, I'm Prudence Zhu, CPA and fee-only financial planner. I've saved and invested aggressively since 2014 and achieved financial freedom 7 years later in 2021. Now I'm helping more professionals and small business owners like you to build and protect wealth so that you could live the life you want. If you're new to my channel, don't forget to subscribe. Let's jump right in. First, what is asset allocation? It is the process of dividing your investments across different types of assets, such as stocks, bonds, real estate, and cash. The main goal of asset allocation is to balance the risk and reward of your investments by adjusting the percentage of each asset class in your portfolio based on your risk tolerance, investment horizon, and financial goals. So let's break down these key concepts further. First, risk tolerance. This is your ability to tolerate fluctuations of your investment's value. The higher your risk tolerance, the more likely you'll get attracted to investments that are volatile but may generate greater returns. Risk tolerance can be affected by factors like your age, financial situation, and investment experience. If you have high risk tolerance, you may allocate more towards stocks and alternative investments, while those with lower risk tolerance may prefer bonds and other less risky assets. For example, Dave Ramsey, who thinks that all debt is evil and that you should always pay by cash, probably has low risk tolerance. That makes sense given that he is older and he has been burned by over-leveraged real estate investments when he was younger. People who prefer to invest in silver, gold, or hide cash under the mattress probably also have low risk tolerance. It is protective if you have a debt issue, but for people who are seeking financial independence, low risk tolerance may be irrational and would slow down your wealth accumulation. You might be able to correct it by improving your financial competency and build a growth mindset. But if it's too ingrained into your money belief, for example, if you're traumatized by a bankruptcy type of experience in the past, you'll need to seek help from a financial therapist. Second concept is investment horizon. This refers to the length of time you plan to hold on to your investments before liquidating to use the funds. Generally, the longer your investment horizon, the higher your risk capacity, meaning you can absorb more risks because you have more time to recover from the potential market downturns and reallocate into safer investments. And on the contrary, as you get closer to the date you need to use the money, the safer your investment have to be. For example, if you are saving to buy a house within a year, you probably wouldn't want to put it in bonds or stock market because if their value goes down, you won't have enough money and would have to delay your purchase. Or you'd have to get more debt, which would most likely worsen your financial situation down the road. Also, when you get closer to retirement age, you should consider shifting a few years of living expenses to safer investments to avoid liquidating your assets in a market downturn. The third key component is financial goals. They should be the driving force behind your investment strategy, and it has to be quantifiable. Common ones are saving for retirement, paying for kids' college, or a down payment on a house or an investment property. Your goals will help determine your target asset allocation. To quantify, you can use return on investment, or ROI, for this calculation. For example, if you have $10,000 and want to get to $1 million in a year, that implies an annual return of 99 times or 9,900%. And usually an investment that promises such insanely high return would either be a scam or super risky. If you decide to go ahead with the investment anyway, you'd most likely be gambling, not investing. And with a gambling mindset, you'd most likely lose that money sooner or later. However, instead of a year, if your goal is to grow it to $1 million in 45 years when you retire, the required rate of return would be 10.78%. A lot more achievable, right? To put it into context, S&P 500 index has annualized average total return of around 11.88% between its inception in 1957 and the end of 2021. By the way, total return includes both the increase in stock price and the return of reinvested dividends. Now, let's explore the 4 main asset classes you can use to build your portfolio. First, stocks. Stocks represent ownership in a company and have historically delivered higher returns than other asset classes. However, they also come with higher risk due to market volatility. And in an economic crisis such as the dot-com bubble, they could become worthless. Stocks can be further divided into subcategories such as large cap, mid cap, and small cap stocks, as well as international and emerging market stocks. There's also a distinction between dividend stocks and high growth stocks. The rule of thumb is that the smaller the company and the less the dividend payout, the higher the risk or volatility. However, they may also provide higher returns. Bonds are debt securities issued by governments or corporations. They are generally considered less risky than stocks and provide a steady stream of income through interest payments. Bonds can be classified as government, corporate, or municipal bonds, and their risk level depends on the credit quality of the issuer. Government bonds also provide tax incentives. Some treasury bonds are free of federal and state taxes, and municipal bonds are free of state and federal taxes when you are a resident of the issuer state. Real estate investments can include physical properties like residential or commercial buildings, or real estate investment trusts or REITs. Real estate offers diversification and potential for capital appreciation, but it can also be illiquid. That means you cannot trade them frequently or easily, and may require active management. A lot of people like investing in real estate because it is tangible and easier to understand. And since the vast majority of the population either rent or own, there are more success stories that can be validated around, and thus easier for people to get inspired and learn from. You can also leverage, which increases your risk but also your return. Focusing on cash flow positive properties can lower the risk of investing in real estate, but those deals are harder to come by in a high interest environment. The fourth category is cash and cash equivalents. This includes assets like savings accounts, 3 to 6 month CDs, money market funds, and short-term treasury bills. These are highly liquid and low-risk investments, but they offer lower returns than other asset classes. And here's a summary. Cash and certificates of deposit or CDs have low returns, and thus do not protect you against inflation. However, they have no or low risk in fluctuation of its value. Real estate has a lower growth rate, on average 3.5% annually in the US, but most people can leverage and amplify actual returns on their initial investment by getting a mortgage. Bonds have medium risk, and the return is not overly exciting either. Stocks, for example, S&P 500 has an average annual total return of close to 10% since inception. To show you what millionaires and billionaires do, here is a popular chart of people's asset distribution by how much they have based on data from the Federal Reserve Survey of Consumer Finances in 2016. You'll notice that once people become millionaires and get even richer, their asset allocation in real estate, which includes primary residence in reddish orange and real estate in ocean blue actually decreased as a percent of their net worth. So is the portion of liquid assets, which is in green. What becomes more and more important contributors of their wealth are stocks in light blue and business interest in dark blue. So if you want to become rich, invest in stocks and own successful businesses. Easy, right? And fixed income, which is mostly bonds in blue with dashes, is an integral part of asset allocation for most people, regardless of how much money they have, but not a significant portion for anyone. In addition, mutual funds, which are in light green, and they could include index funds, are important for millionaires and multimillionaires, but less important to billionaires. It's probably because they could get better returns with stocks and businesses. For background information, mutual funds usually are a mix of stocks, bonds, and short-term debt. And you need to read about what the fund invests in and its investment strategy before investing. Yahoo Finance and Morningstar are good places to start. And if you want to dig deeper, you can study the shareholders' reports. Now, let me share my personal experience and strategy by using some real numbers. When I first started out on my financial freedom journey, I had high risk tolerance since I was young, fairly rational, and financially well educated. So I maxed out my 401k and HSA to take advantage of the tax savings and saved in addition wherever I could. I invested almost 100% in low expense ratio index funds and stocks. All combined, my family saved and invested around 40% of our income. And when our job stabilized, we bought a 2-unit multifamily home in 2016 and another single-family house in 2020 when we moved to Phoenix. Now, real estate accounts for a little more than 40% of our net worth, and the dip in 2019 through 2021 for real estate was not because we lost money, but because the stock market was going crazy in those 3 years. And as a result, it became a larger portion of our net worth. You might ask why we didn't rebalance our portfolio. And that's because we have high risk tolerance and we were okay with our exposure to the fluctuations of the stock market for its potential returns. To break it down, our holdings in mutual funds and stocks are in many different accounts for different purposes and tax advantages. Brokerage for liquidity, education for the kids' college, HSA for healthcare after retirement, which may not be enough, and retirement for most living expenses in retirement, which is currently primarily in pre-tax accounts. But we will convert a good portion to Roth accounts as I expect our future income would go up, and as a result, we would be in a higher tax bracket. Cars are minimal in our net worth. Business interest, which is the business I'm starting, it is small for now, but hopefully it would become a lot bigger in the next decade. Real estate has been stabilized at around 40%, but would probably go down as my business grows. And here's a closer look at the recent couple of years where the stock market wasn't performing so well. You can see that starting March 2022, our brokerage and retirement accounts visibly shrunk, and it kept going down until the beginning of 2023. However, for the first 3 quarters of 2022, our total net worth didn't go down as much because our real estate values were still strong. At the beginning of 2023, however, both real estate and the stock market were down, so we had a visible dip in our net worth. Luckily, it picked back up by the end of first quarter of 2023. This gave us some breathing room and also warmed us up for what might lie ahead. We liquidated a portion of our brokerage account to pay down a new mortgage we got that has a high interest rate. And here is detailed percentages by asset as the end of first quarter of 2023. Overall, we're still fully vested in the market and ready for the ride. If the worst becomes reality, we are confident that our balanced asset allocation and strategy will ensure our lifestyle won't be materially impacted. and the downturn is only temporary. You have to keep in mind that good assets will keep going up in value over the long run. So don't panic when the market is down. Stay disciplined and focus on your long-term goals. And avoid making impulsive decisions based on short-term fluctuations. And that's it for today's video on asset allocation. Remember, a well-balanced investment portfolio can reduce anxiety related to market volatilities while helping you achieve your financial goals. If you found this video helpful, please give it a thumbs up and share it with others. Don't forget to subscribe for more investment tips and strategies. Thank you for watching and keep investing. See you next time.